And welcome. Today, we're diving deep into the foundational principles of one of the world's most successful investors. This is Warren Buffett's investment philosophy, focusing on the critical lessons from his 1960 letter to partners. We'll start with a quote that cuts to the very heart of his strategy. "I would consider a year in which we declined 15% and the average 30% to be much superior to a year when both we and the average advanced 20%. Let's unpack what that really means. To understand Buffett's mindset, we first need to look at the market environment. 1960 was a year of reversal. In 1959, the Dow Jones Industrial Average saw strong growth, rising 16.4%. But in 1960, the market reversed course and the Dow fell 9.3%. Now here's where it gets interesting. In the strong market of 1959, less than 10% of investment companies managed to match or beat the Dow's 16.4% gain. The majority underperformed. However, in the weak market of 1960, the tables turned. About 90% of those same companies outperformed the Dow's decline. Their results clustered in a tight range, between a 5% gain and a 5% loss. The key insight here is that many professional managers were positioned more conservatively than the blue-chip stocks in the Dow. This allowed them to capture less of the upside in rising markets, but provided much better protection during downturns. This context shaped Buffett's core performance philosophy, which was to perform better in declining markets. First, his primary objective was long-term superiority. He aimed to achieve performance superior to the Dow Jones Industrial Average over the long haul. He saw the Dow as a proxy for the performance of leading investment companies, and beating it was, in his words, the reason for the existence of the partnerships. Second, his approach to performance measurement was unconventional. He geared his thinking toward a 5-year performance cycle, not single years. He focused on relative success rather than absolute numbers. He famously used a golf analogy. The important thing is to be beating par. A 4 on a par 3 hole is not as good as a 5 on a par 5 hole. In other words, performance is relative to the difficulty of the environment. Finally, this led to a specific market behavior strategy. In stable or declining markets, he expected better than average performance by investing in undervalued stocks and special situations. Conversely, in strongly rising markets, he anticipated average or perhaps even poorer than average performance. This was because his strategy was more conservative and insulated from the market's speculative behavior. The key takeaway is this: Buffett's philosophy emphasizes relative performance over absolute gains, focusing on outperforming in down markets. This brings us back to that foundational quote. "I would consider a year in which we declined 15% and the average 30% to be much superior to a year when both we and the average advanced 20%. Let's break this down. In the first scenario, his fund outperforms the market by 15 percentage points. In the second, it simply matches the market. For Buffett, the real measure of success was this margin of victory, especially in tough times. It's about focusing on the long-term record of outperformance, not the emotional highs and lows of individual good and bad years. And the results proved his philosophy worked. Let's look at the annual performance of his partnerships compared to the Dow. In 1957, with 3 partnerships, the funds gained 10.4%, while the Dow lost 8.4%. In 1958, with 5 partnerships, they were up an incredible 40.9%, narrowly beating the Dow's 38.5% gain. In 1959, now with 6 partnerships, they gained 25.9% against the Dow's 19.9%. And in the down year of 1960, with 7 partnerships, they achieved a positive 22.8% return, while the Dow lost 6.3%. It's important to note these results were calculated after expenses but before interest payments to partners or allocations to Buffett as the general partner. The key insight is that the partnerships showed incredibly strong relative performance, especially in 1960 when they posted a significant gain while the market fell. When you look at these results cumulatively, you see the true power of compounding. This chart shows how an initial investment would have grown. Buffett's partnerships demonstrated far superior compound returns. Over the 4 years from 1957 to 1960, the partnership's cumulative gain was a staggering 140.6%. In contrast, the Dow Jones gained only 42.6%. This widening performance gap is the result of compounding. The key insight is that superior performance in down or stable markets, combined with solid performance in rising markets, created a massive compound growth advantage. So how did Buffett find these opportunities? A perfect example is the Sanborn Map Company. For 75 years, Sanborn had a near-monopoly business publishing highly detailed maps of all U.S. cities, used primarily by fire insurance companies to underwrite risks. It was a business with consistent profits, immune to recessions. But the business began to evolve. From the 1930s to the 1950s, Sanborn started accumulating a large investment portfolio. Then, in the early 1950s, a new, cheaper method of underwriting called carding began to eat into Sanborn's map business. By 1958, the map business's after-tax profits had collapsed, falling from over $500,000 a year to less than $100,000. This created a huge investment opportunity. The market was so focused on the dying map business that it was undervaluing the company's large and growing investment portfolio. In 1958, an investor could buy Sanborn stock for $45 a share and get a claim on $65 worth of high-quality securities. The problem was an inert board of directors who were content with the portfolio income and saw no urgency to fix the map business. This case is a classic demonstration of how market mispricing can create incredible opportunities. This slide perfectly illustrates the value disconnect. In 1938, the stock traded at $110 per share, when the investment portfolio was only worth about $20 per share. The map business was prized. Fast forward to 1958. The stock price had fallen to $45, but the investment portfolio had grown to be worth about $65 per share. The market was essentially valuing the profitable map business at a negative $20 per share. Why? Because the map business's profits had declined sharply, and this was compounded by board inertia. 9 of the 14 directors were from the insurance industry with little interest in Sanborn's future. They were happy with the easy income from the investments and saw no reason to revitalize the core business. This created the mispricing opportunity: buy $65 worth of assets for just $45 and get the map business for less than nothing. The insight is that a declining business can overshadow valuable assets, especially when management is passive. So, what was Buffett's strategy? First, his partnerships began acquiring stock, buying a large block from the unhappy family of a former president and then allying with other disgruntled shareholders to form a controlling group. Next, they proposed a fair exchange plan. This allowed any stockholder to exchange their shares for their proportional slice of the company's investment portfolio at fair market value. This clever plan avoided a lengthy and costly proxy fight. The outcome was a success. About 72% of the company's stock was exchanged for the securities. The remaining company was left with over $12.5 million in reserve funds. And the remaining shareholders enjoyed higher earnings per share and increased dividends. There were several key lessons here. It taught Buffett the value of patience, as these control situations take time. It showed the power of special situation investing, where profits come from specific corporate actions, not the market's mood. It reinforced the idea that there is immense value in neglected assets, and it highlighted the need for secrecy when building a large position to avoid driving up the price. As Buffett wrote, necessarily, the above little melodrama is a very abbreviated description. However, it does point up the necessity for secrecy regarding our portfolio operations, as well as the futility of measuring our results over a short span of time, such as a year. So, to conclude, what are the key investment principles from Buffett's 1960 letter? First, long-term superiority. Focus on beating the market averages over a long period. Second, asymmetrical returns. Aim for better-than-average performance in down markets, even if it means average performance in up markets, by holding a conservative portfolio. Third, performance measurement. Judge success based on relative performance. Remember, a 15% loss when the market is down 30% is a huge victory. Fourth, A. Conservative portfolio. Focus on undervalued securities in special situations that provide a margin of safety. Fifth, find value in neglected assets. Look for opportunities where the market is overlooking valuable assets within a company. And sixth, invest in special situations. Find opportunities where profit depends on a specific corporate action, not on the whim of the market. Buffett's own words summarize it best. The important thing is to be beating par, and to recognize the futility of measuring our results over a short span of time, such as a year.